Hello, everyone. My name is Oscar Valdez Vieira. I'm a private equity and capital markets policy analyst at Americans for Financial Reform. AFR is an organization that was created in the aftermath of the 2008 financial crisis to make sure that that disaster never repeats and to push for strong rules that would transform the financial system so that it serves the economy and not the other way around. Today's conversation it's part of a series, and we are examining the growing risks to financial stability from the Trump deregulation agenda and from runaway financial speculation. I see some questions in the chat already, and yes, this presentation will be recorded and then we'll distribute it later. And we'll go over some questions with our guest, and then we'll open it up for some questions that people can drop in the Q&A box below. So just wanted to start by doing some table setting and about the efforts that we're seeing rolling back the Dodd-Frank Act guardrails, weekend oversight, and basically give Wall Street green light to gamble with people's money. So a lot of that risk is now showing up in the artificial intelligence sector, which is highly concentrated and has been driven a stock market boom, in part fueled by private capital and a lot of debt. And even insiders are warning these days that there is a looming bust and a potential crisis in the horizon. So, we are worried that when this speculative frenzies unwind, it's not just the billionaire investors who pay the price. It's usually the public, it's pensions, it's jobs, it's state and local budgets. So we're exploring these questions in this series of webinars about the moment we're in, and where this is another 2008 crisis in the making, and what should regulators be doing right now to guard against the risk of another financial crisis. So with that, and to help us think about all of that, we are very fortunate today to be joined by someone who has been in moments like this before. Our guest today is Damon Silvers. Damon Silvers served as deputy chair of the Congressional Oversight Panel for TARP, that's the Troubled Asset Relief Program, basically the 2008 bank bailout program. And he helped uncover and explain the financial practices that led to the financial crisis and oversaw the bailout program. And for many years, Damon also directed financial markets policy at the AFL-CIO, where he was a senior strategic advisor and special counsel to the president. And he's currently a visiting professor at University College London and Newcastle University, and a senior advisor to the American Federation of Teachers, as well as the AFL. Damon has also served in multiple agency advisory boards regarding capital markets, corporate governance, and financial regulation, and also sits on AFR's board, by the way. Damon, thank you so much for joining us today.
It's a pleasure to be with you, Oscar, and to be part of AFR's effort to understand the moment and to be with everyone online.
Thank you. And yeah, thank you to everyone joining. So, Damon, why don't we just jump in? And I thought that, you have an interesting combination of perspective. We were talking about it in the back room before opening the webinar. And why don't you start us off by doing a little bit of table setting? You have been on the front lines of major financial crises before, from the dotcom bust, the Enron scandal, and then the 2008 financial crisis. So, we are hearing a lot these days about how, the similarities of this moment to 2008. So, and where we are heading towards a similar bust. So wanted to hear your perspectives about that.
Sure, Oscar. Well, let me start off by saying, obviously, you introduced me and all my different affiliations. I'm here speaking on my own behalf and not on behalf of any organization. Secondly, I think we have to preface this by saying that, you can identify risks, you can't identify certainties, right? It would be a very foolish thing to say X is going to happen. Right, but with that caveat, I think that what we are seeing right now has a lot of things in common with the run up to prior financial crises, and is really worth a certain amount of attention and preventative action. Let me talk about that. And you mentioned the dot-com bust, which occurred in 2000 and the years following, and was associated with the collapse of Enron and some other very large companies, large cap companies, some of which were tech, some of which weren't. The financial crises can take a number of different shapes, right? Right now, I think it's very hard not to come to the conclusion that we have an overvalued equities market. Our stock market is worth more than the likely earnings of those stocks in the future. That's a bubble. That's people had a stock bubble. That it happens. There's exuberance in markets, and this bubble in particular is not confined, but is mostly a tiny number of companies, right? So there are 7 firms, the Magnificent Seven, all of which are connected with AI in some way and are all household names. There are 7 firms that make up 35% of the total value of the S&P 500, right? And those firms have contributed wildly disproportionately to the run-up in the overall value of the stock market over the last couple of years. And so we're really starting off with that. And just to give an example, right? The stock prices are priced in comparison with the earnings of the companies. So NVIDIA, which makes chips for AI, NVIDIA's stock price has been as high as 55 times its earnings in recent weeks. It's now 45. What does that number mean? In October 1929, just before the Great Crash, the earnings multiple of the stock market was 18. Right? Earnings multiples in the 50s are associated with crises. Right? They generally only happen when you have companies with huge growth, or when you have a crisis in which the earnings of companies have collapsed. These are numbers that speak very highly of a bubble, of values that are not going to be sustained. All right, so that's a stock market bubble. Now, if the prices of the Magnificent Seven fell to more rational levels, that would cause a decline in the stock market. We saw something like that in 2000. We saw a very rapid decline in the prices of all tech stocks. We saw a bunch of tech companies go bankrupt. We saw a revaluation in the minds of investors of tech companies. What we didn't have happen in 2000 was a full-on financial crisis, because the collapse in stock prices did not turn into a credit market crisis, a debt crisis. 2008, 2009 was a stock market crisis and a debt crisis. And so was 1929. And so were panics in the distant past, which had terrible consequences, like the Panic of 1873, which had to do with railroads, which may seem like forever ago, but is actually highly relevant to the AI situation. So the big question in front of us, I think, is if and when stock prices return to more rational levels, will that fall in stock prices cause a credit crisis? And that's a question that regulators could affect the answer to. Prudent action now could make that issue of contagion a lot less likely. And contagion is really important, because if a financial crisis spreads from the equity markets to the credit markets, it will almost certainly cause a major recession, if not a depression. So that's kind of the setup we have here today. Now, I'm going to throw a question back to you, but I want to talk a bit about why it is that these companies are likely overvalued. There's a deep reason that we need to get into here. But Oscar, let me put it back to you at that
Yeah,
point.
thanks. No, that's great. Yeah, actually, we can talk more about that. You already mentioned a couple of terms, stock market bubble, financial crisis. So it would be good to get some definitions around what that means and what you mean by overvalued. So yeah, please go ahead.
Sure. So why are stocks worth what they're worth? They're worth that because of what people believe those companies are going to earn in the future. Right? To some degree, they're based on the actual assets of the company today, but mostly they're based on projections of future earnings. When a stock market bubble is when people bid up the prices of stocks in the stock market way past any rational assessment of what their likely future earnings would be. And this is a common thing that happens during periods of enthusiasm for new technologies. Right? People don't know really. It's hard to know what a brand new technology will mean in terms of corporate profits and who will get them, who will successfully exploit that technology. The more transformative the technology, the more likely there's the possibility for markets to make a mistake, particularly early on. And obviously, AI is a pretty transformative technology, and AI and beliefs about what AI is going to do are driving the run up in stock prices, and particularly the run up in the quote Magnificent Seven, the AI companies. Now, how profitable is AI going to be? Well, you could probably, most people think AI is in general going to make some money, a lot of money for some people. But who and when is unknown. And the when is really important. Because right now, today, right, the best estimates are that actual revenues, cash coming in from AI is trivial. It's a couple $1 billion a year to all of them. Now, by all of them, I mean the companies that are selling AI services. NVIDIA, the chip maker, they're getting all kinds of money coming in, right? But that money is coming to them from the companies trying to compete in the AI business, from the Microsofts and the Googles and the Amazons. Their AI revenue right now is very small. And people who are studying, people with experience and knowledge about economic transformation, who are studying AI and business right now, are saying it's going to take some time before businesses really figure out how to make money in AI. That gap is the potential source of a truly catastrophic financial crisis. Right? And we've seen this before. To some degree, the crash of the obviously the dot-com crisis was exactly this. The dot-com crisis was people getting ahead of themselves in terms of the internet's ability to generate cash. 1929 was to some degree about people getting ahead of themselves around consumer electronics and aerospace. The truly catastrophic crisis of 1873 was about investors getting way ahead of themselves about railroads. All these were transformative technologies like AI. And this is the core economic issue that underlies why we're talking about bubbles and why we're talking about the risk of a broader financial crisis and broader contagion.
Thanks. I think that makes a lot of sense, right? Like a lot of people think that because the stock market is always, no, not always, but it's going up, and the headlines numbers would look good, then there's nothing to worry about, right? And that kind of makes people feel safe. And but there's a lot missing from that picture, right? Anything else you want to add about that?
Well, definitely. I mean, for starters, right, all financial crises begin with the market going up, then the market goes down, right? The fact that the market goes up is not necessarily a good sign in terms of the threat of a financial crisis, particularly if the market seems to be rising in a way that is detached from economic and financial reality, right? The second thing is, so yeah, I mean, the fact that the stock market is going up does not necessarily mean that it won't go down. In fact, it might mean that it's quite likely to go down. Very narrow advances are a bad sign. But there's a second thing here. I mean, I was amazed recently. NVIDIA, which makes the chips, as we were talking about, put out their earnings statement. And their earnings statement was pretty good. And everybody did like a little dance of joy, right? But this misunderstands the whole situation. Because as I said earlier, NVIDIA is the supplier, right? NVIDIA is the supplier. NVIDIA is going to make money as long as people are buying chips. The real question is, can the providers of AI services, can they sustain the level of investment that they are doing, which is leading them to buy things from NVIDIA? Right? The AI bubble, if it breaks, is not going to break in NVIDIA. It's going to break at the competitors to establish dominance in AI, who are building the who are building the neural networks and building the data centers and so forth. It's them running out of cash that potentially is the triggering event.
Right. Thanks. Um, so you already mentioned another couple of things. You already mentioned interconnectedness in the system and debt being very important for a credit crisis. And actually, we said we would answer questions at the end, but there's already a question in the chat about defining credit crisis. So if that's, we can throw that in, that'd be great. So I'm thinking about, debt and interconnectedness and how subprime mortgages, or specifically more securitization of subprime mortgages, played the role of the ticking time bomb in 2008, right? So when people are thinking about parallels to this moment, and what are we trying to what should people be trying to figure out? What is the new subprime mortgage in this moment?
Right. Well, let's talk about just in general terms about what a credit crisis is. In a credit crisis, it turns out that large parts of the assets of debt related assets. What's a debt related asset? A bond, right, or a bank loan, or a credit card receivable. A credit crisis is when it turns out that large parts of these assets that are being carried on the books of all kinds of institutions and households are not worth what people say they're worth. Right? That the loans aren't going to be repaid. That the collateral, whether it's a house or a credit card receivable or a car, the collateral is not worth what people said it was worth. Right? Now, the thing about a credit crisis is in a credit crisis, the institutions that provide credit, the financial intermediaries, of which banks are the best known, these institutions become financially unstable. Sometimes they go bankrupt. That causes a contraction in the availability of credit in the economy, which is why you get recessions and depressions. But even worse is the combination of a credit crisis with essentially badly regulated financial markets and often corruption, in which people come to doubt what they know. When participants in credit markets start to think, I don't know whether my counterparty is solvent or not, or even worse, and this happened in 2008, I don't know whether I'm solvent enough, right? I don't know what my cash needs are going to be tomorrow. When that starts, the credit system freezes. And when the credit system freezes, people cannot do business, right? If I can't get money, if I'm running an auto company and I can't get cash when I need it, right? I'm going to contract everything, right? This is what they call contagion. And this is what produces not just recessions, but depressions. Right? In the end, the Great Depression cut the U.S. GDP by 25%. Paul Volcker told me that he thought that during the 2008 financial crisis, financial contagion and consequent economic contraction was more severe at its peak in its rapidity than the Great Depression. And only extremely aggressive policy moves by the Federal Reserve and ultimately by the Obama administration led and the bank bailout itself arrested that catastrophic decline in the entire economy. Now, that's what a credit crisis looks like. What is the source of a credit crisis in this situation? I see four sources, right, that are potentially in play. And I fear that they are not being watched by the regulators that under Dodd-Frank ought to be watching. Okay, so the four sources I see are first, loans that have been issued, loans that have been made to companies and entities that are involved in building data centers and building AI capacity. Now, these loans, as you mentioned, Oscar, are substantially opaque because they're in the private credit system. All right. They've been made by essentially the lending arms of private equity firms. But where do those people get their money? All right. According to Bloomberg, 35% of the total assets of the US insurance system are now invested in private debt funds. That's a crazy number. And that reminds me of AIG, one of the companies that triggered a huge insurance company that helped trigger the 2008 financial crisis. So even though these private credit funds are not visible, very visible, very important financial institutions, insurance companies, are heavily invested in those funds. So that's one, direct credit. And there are warning signs today that some of the weaker participants in the AI market are already at the limits of their credit capacity. So the one that really strikes me is that last summer, XAI, Elon Musk's AI company, borrowed money to build out AI capacity, and they were paying 13% plus a kicker. Now, right now, junk bonds in this country are being sold at around 8. So Elon Musk's company is paying 500 basis points over junk for credit to do AI. That sounds like somebody reaching the end of their string. And it's my understanding that they are now seeking more loans at even more expensive terms. Now, the reason why Musk is so important in this story is because Musk's parent company, Tesla, is having difficulty in the auto business and is only throwing off about $15 billion in free cash a year. To compete in the AI business, you need about $100 billion in cash per year to invest. It's mysterious to me how Musk is going to get that kind of money, right? And that kind of money is stretching the financial capacity even of the giant platform companies that have free cash flows at that level. So it's just straight up credit. And what would happen if that credit failed? But it doesn't stop there. We have allowed the cryptocurrency market to expand very substantially. And something that is not well understood by many people in that market and many observers of that market is very highly correlated with the stock market. So Bitcoin has a beta. Beta measures the correlation of a financial asset with the market, with the stock market. Bitcoin has a beta of 2. That means for every dollar the stock market goes up or down, Bitcoin goes up $2 or down $2. If there is a rapid retreat in the stock market, one can expect to see a rapid retreat in Bitcoin, and it seems perhaps it's already happening. Now, that would just be another piece of financial fluff if it wasn't the case that the Trump administration has pushed Bitcoin into the banking system and has allowed the creation of non-bank banks using cryptocurrency. Stablecoin. Oops, there seems to be a sound problem, Oscar.
I can hear you fine. I'm not sure if
You,
that's someone's computer or
uh,
if
anyway,
anyone else can let us know if they're having trouble.
The Bitcoin.
Yeah, it seems to be fine. Please go ahead.
All right. So something like stablecoin is really a kind of bank. It's a financial intermediary. Stablecoin represents that there are assets to back it up, to keep it stable, to keep its value flat. But some of those assets are cryptocurrency themselves. There is and this resembles now some of the things that went on in the subprime mortgage business, where bad loans were pyramided on bad loans, and people then said, "Well, this is safe because you've got the best you've got the best part of bad loans pulled with the best part of other bad loans." But it turns out that the best part of a bad loan is still pretty bad, right? So a stable coin that has Bitcoin as an underlying backing asset, or another kind of cryptocurrency as an underlying backing asset, is a potentially very dangerous construction if there is a rapid retreat in the value of crypto, which it's likely will follow a rapid retreat in the value of the AI stocks, because these things have been correlated historically. But it doesn't stop there. The run-up of the stock market, like in 1929, the run-up of the stock market has been accompanied by a huge expansion in margin accounts, people borrowing money against their stock holdings. If there's a rapid retreat in stock prices, people will be forced to sell those stocks to pay their loans. That will accelerate the retreat of the stock market. But it's also quite possible that if the market retreats fast enough, those loans won't get paid back. And the institutions that made them will have a loss problem that will then constitute credit market contagion. And fourth, you have this issue of the AI business requiring so much energy. and people all over our economy right now scrambling to build energy infrastructure to service AI and financing that energy infrastructure. Now, that's all well and good unless the AI companies can't pay their utility bills. And if that turns out to be the case, then you could have contagion moving through the energy sector as well. All of these things are to varying degrees opaque. And so if they start going wrong, the likelihood that market participants will panic and conclude that they don't know where the risk is, and therefore they won't do anything. They won't put any money out for fear that they're going to get caught in something, right? Is expanded. My back of the envelope calculation is that if you just look at the equity values of the Magnificent Seven and the crypto world and the debt associated with the Magnificent Seven, you're talking north of $20 trillion. That is enough money, which if its true value becomes uncertain, that is enough value. That's enough money to cause contagion.
Right. And let me ask you something else about that. So the traditional banks are also on the hook, right? Because they are backing a lot of these loans that are going through the private credit system and through private equity and insurers, right?
The full degree of the traditional bank's exposure here is unclear. There's no question there is some. How much? It's very hard to tell because as in the subprime crisis, I'll tell you a story about subprime. The head of the audit committee of Citigroup said to me during the subprime crisis, he said, "We didn't make any subprime loans. We didn't make any subprime loans. Don't blame us." Now, that was technically true. Citi Mortgage did not make subprime loans. But what Citigroup did was finance storefront operations that made subprime loans and then securitize them under the Citigroup name. So when they started to fail, Citi's credit reputation was on the line, even though Citi did not actually owe any of that money. And Citi had to make good on those pools of mortgages, even though in theory they were off Citi's books. The capacity for the banking system to be embedded in a bubble is very great. And the only people who really know, besides the bankers themselves, are the Federal Reserve and the OCC and the FDIC. And I wouldn't hazard a guess as to how exposed the banks are, but my view is that the regulators right now should be trying to find that out. Every resource available should be out there trying to assess to what degree are the country's big banks in particular, but all banks, to what degree are they exposed to this combination of risks that I went through before?
Yeah. And a lot of that risk, well, a lot of that private credit is also being securitized, right? It's also being repackaged and sold. And so we're seeing again, mortgage-backed securities, in this case, commercial mortgage-backed securities, and the other type of products that were, in 2008 problematic, like credit default swaps. All of that is having a revival now.
Now, in theory, at least, some of those things are a lot less dangerous than they used to be, right? Credit default swaps, for example, are supposed to be run through exchanges with capital behind them and so forth. I think it's unlikely that we will see the same things be the same, that we'll see a complete repeat of 2008. But I will tell you something. At the last IMF meeting, there were closed door conversations with senior IMF officials where they said, we are worried about contagion into the financial markets from what effectively we see as an equity bubble, right? The notion that there's an equity bubble at this point is not terribly controversial. The Bank of England has said it. Andrew Ross Sorkin at the New York Times has said it. All kinds of people have said it. And Jamie Dimon may even have said it. The issue is not so much the idea that maybe some stocks are overvalued. The issue is, are we at risk of contagion into the credit markets? The IMF guys said in these closed door meetings that they see signs of contagion into the credit markets, not where I was just talking about, but in consumer markets, right? They see a weakening of consumer credit markets, credit cards, mortgages, et cetera. They see that and are worried about that. And that is a further knock-on effect, right? It could well be that in the context of what is already a weak consumer demand world, right, and a and a cost of living crisis, not just in the United States, but across the developed world. It could well be that a deflating of the stock market bubble could trigger a set of events that would lead to big problems in consumer debt markets. I haven't even talked about that, but that would be, those markets are gigantic. And to the extent that there is a 2008 like problem in any of those markets, that's a huge accelerant.
Yeah. So, and I want to get there, but I was thinking before we get there, there is a good question in the chat actually that I wanted to bring up, and it's related to uh, sometimes we see, and something that is coming a lot from the tech industry, which is this narrative that basically says like it doesn't matter if there is some speculation right now or some stock mania because AI will eventually transform everything and it will eventually be profitable. So short-term turmoil is basically irrelevant if it eventually does become profitable. So there are some questions about that in the chat. Maybe you could address a little bit of that.
Yeah. I think this is the key matter. This is the heart of the matter. I don't really doubt that at some point AI and the associated technologies around it are going to be enormous drivers of productivity and value. I don't. How could they not be? But the question is when, right? And to the extent there is a gap in time between these huge capital investments that the companies competing in AI are making, and businesses generally figuring out how to really make money out of AI, and the AI companies figuring out how to avoid AI becoming a commodity, right? Which is then not very profitable. If that gap exists, in that gap in time is when you could have a very severe financial crisis. Now, this is not like, I'm not making this up. This has happened before. And it's happened before with technologies that are at least as transformative as AI, and in the long run produced enormous value. So the real example that should cause people real concern is what happened to the railroads in 1873. Railroads, talk about transformation. Think about what railroads did in a world before cars, before meaningful telecom, before airplanes, right? Think about the enormous impact of railroads on the American economy and on the world economy. They basically created modern capitalism. In the late 1860s and early 1870s, throughout the world, everybody was building railroads as fast as they could. And American railroad companies raised huge amounts of money, both in the United States and overseas, to build railroads. They built railroads out into the plains, across the country, every which way. They built railroads way ahead of people, and they got no cash flow back. Once markets realized this, once railroads started defaulting on bonds, the entire financial structure around the railroad industry collapsed. Right? The result was a decade of severe recession. The result was huge financial losses, a decade of severe recession and social unrest. The railroad strike of 1877, that some people may be familiar with, was the consequence of the railroad bubble bursting. You want to talk about severe? The railroad strike of 1877 ultimately led to the United States Army being deployed in the streets of our major cities, pitched gun battles, and for a brief time, a kind of American Soviet in Pittsburgh, in Baltimore, and in Chicago. But the crash of 73 led to gigantic suffering, huge suffering in the American people and around the world. It's not an experience we'd want to repeat. All those railroads eventually made money, but not those investors. Those investors got wiped out. Now, this may sound like ancient history, but the same thing more or less happened with the foundational tech company Global Crossing in the late 90s and early 2000s. Global Crossing laid the cable that created the world we live in today. There would none of what we have in terms of the kind of amazing nature of the internet today would have been possible without the cables Global Crossing laid in the late 90s and early 2000s. Global Crossing went bankrupt because there was not the demand for all that capacity. Global Crossing went bankrupt, and yet those cables today are making money for the people who own them, and are driving the whole globally networked world with video on demand and everything we take for granted is the result of those cables. But Global Crossing went bankrupt, and its investors lost everything. The risk here is not the source of the risk here is not the idea that AI is a fraud or nobody's ever going to make money. It's the fact that the revenues from AI may be sometime in the future, and the people who are financing AI, particularly the lenders, will want to get paid today.
Right. It's the old the market can stay rational a lot longer than that you can stay liquid, right?
Yes, that's exactly right. Or to put it another way, what John Maynard Keynes famously said, in the long run, we are all dead.
Right. Yeah.
which means what matters is what happens more closer in time.
Right. So we're starting to get short on time. So and I wanted to talk a little bit about the regulatory agenda and or the dismantling of that and what regulators should be doing now and what regulators should do in a crisis. But maybe before we go into that, you alluded to consumer debt and that you wanted to say something about the relation between stock market, AI, crypto, consumer debt, and how those are not really, separate stories, might be more like a,
Well,
thread of a
Oscar, I touched upon it about as far as I have knowledge about it. I think the key thing to understand here is that if you see an economic contraction, there is a fair amount of data out there that suggests that consumer credit markets have softness in them, that delinquencies and delinquencies and defaults in consumer credit markets are rising. And the if there were to be a financial crisis driven by AI, that could trigger much higher rates of defaults in the consumer credit markets, which could then further accelerate a credit crisis. Right? That seems to me to be a real risk. And in terms of what regulators need to do, right? The Dodd-Frank structure gives regulators the power to act, to act preemptively here, to do things that would lessen the likelihood of contagion. Now, I don't think regulators can do anything to keep irrational prices irrational, nor should they, in terms of the stock price of any of these companies. But they ought to be looking very closely at potential channels of financial contagion in the credit markets. And what that basically means is asking the question of banks, insurance companies, and other financial intermediaries, what is your exposure to AI-related debt? What is your exposure? To what degree is our crypto assets embedded in your balance sheets, right? On the asset side, right? To what degree to what degree are you exposed to stock market margin, to margin accounts, to margin bets, right? And finally, to what degree are you exposed to debt that is related to energy infrastructure that will fund AI? And the purpose here is not to strangle anybody. The purpose here is to keep those levels at levels where losses could be borne, right? Where we're not going to have a banking crisis if it turns out that a lot of these instruments are not worth what people think they're worth.
Right. So, um, can you talk a little bit more about the whole context for this conversation, right? Like I said at the beginning, the Trump administration and Republicans in Congress pushing to weaken the safeguards and roll back parts of the post 2008 reform agenda. Is that shaping how dangerous this looming crisis can become?
Oh, very much so. I mean, I think our listeners should understand, right, that President Trump has staffed the regulatory agencies with people who are hostile to the missions of those agencies, right? Now, he doesn't control the Federal Reserve, so the Federal Reserve remains what it is. But at the OCC and at the Treasury Department, and certainly at the Securities and Exchange Commission and the Commodities Futures Trading Commission, we've got leadership that doesn't think financial regulation is necessary. And in some cases, like Paul Atkins at the SEC, people were very, very close to crypto, right? and have basically been put in office to make sure that crypto is unregulated. This is the recipe. This is the recipe for a financial crisis, by the way. This type of approach is what has preceded each of the major financial crises in both parties. This kind of deregulatory approach, and we have seen very specific acts that, shall we say, increase rather than decrease the level of risk. For example, the weakening of bank capital requirements across the board, and the encouraging, in a more informal way, of the inclusion of crypto in bank balance sheets, and essentially looking the other way while various kind of non-bank banks get set up, which are then potential sources of disintermediation and financial crisis. Right? I think one can say that this administration is undermining both the letter and the spirit of Dodd-Frank, and doing so in ways that they may come to regret in a big way. Because if the kinds of dynamics that I've been warning about kick off, they're going to be extremely hard to manage. And I think they're going to be particularly extremely hard to manage for this team of federal officials.
Got it. So before we turn to what an actual, a crisis would actually look like and potential responses, is there something to say? Is there anything to say about the role of the U.S. dollar in all of this?
Yes, well, the dollar is the background here. So if one of the things that has happened sort of almost perversely in the past has been that even as the United States has been the center of, say, the 2008 financial crisis, which went global but started here, even as the United States has been the center of these very destabilizing global financial dynamics, foreign investors rushed to the dollar. In the past, foreign investors have rushed to the dollar, even as the United States has been the source of contagion, because of the dollar's central role in global currency markets, and its role as the reserve currency, and also because of a deep belief in the ultimate underlying stability of the U.S. financial system and the effectiveness of the U.S. financial regulatory system and our central bank. Now, the risks that I'm describing run the risk of poorly managed a crisis, a kind of worst case scenario crisis of the kind I described, has a final worst case in certain respects, which would be to undermine the belief of global investors that the United States really is stable and that the dollar really can be trusted in the long run. And if a whiff of that were to occur, it would be an enormous accelerant to contagion in our financial system and consequent with retracting of economic activity. I'm not saying, by the way, that the value of the dollar should always go up, but I'm saying that a deep change in global psychology around the dollar could be triggered by a very severe financial crisis. And we also have to recognize that we live in a world where not everybody is our friend, and that potentially rivals of ours, people who think that their country rather than the United States should be the center of the global financial system, they might be emboldened to take various actions that would, again, create essentially a contest for what is the global reserve currency and the like, and that would, I think, very much not be in the United States' interest.
Right. Thanks. So, maybe a couple more questions before we turn to some of the audience questions. Wondering if you could talk a little bit more about what regulators in Congress should be doing right now to lessen or prevent the severity of a crisis.
Yeah, Oscar, I mentioned this earlier, but it's just worth repeating, right? The regulators should be right now asking their regulated entities, and this is not just federal regulators, but state banking and insurance regulators, They should be asking the entities they regulate, what is your exposure to the four categories I went through? What's your exposure to actual direct debt related to AI? What's your exposure related to stock market margin accounts related to the Magnificent Seven and to the market as a whole? What's your exposure to crypto? That would be large. Certainly, your exposure to lending using crypto as collateral, but also your exposure to crypto on your own balance sheet as an asset. And then finally, what's your exposure to crypto, not crypto, AI, to AI related energy investment? Energy investment that depends upon this kind of hockey stick of demand for electricity from the AI industry. That's what regulators ought to be doing. And members of Congress and members of state legislators that are relevant to these regulators should need to be asking the regulators to do it, to look for these things, and not just to look for them, but to insist that regulated entities have be able to withstand a downturn in the equities market and potentially credit losses in these spaces, right?
Right.
And also try to understand actually how all of these things interact with the private credit markets, particularly insurance.
Right. And, to say the obvious, like the administration and the current Congress are moving in the not the opposite direction, but definitely not in the not in the right direction.
There was no sign that anyone is doing this. There was
Right.
no sign that anyone is asking this kind of question. And if we wait till the downturn happens, it will be too late.
Right. So, and all right, the few minutes we have left, maybe we can talk a little bit about what if that crisis comes, what if that happens, if it actually happens, and there are already talks in some corners about potential bailouts and preemptively guaranteeing AI firms some of the kind of support that banks received back in 2008. What should we be expecting or trying to prevent from potential bailouts?
Well, I mean, among the scariest things that's happened in recent weeks was Sam Altman of OpenAI raising the issue of a bailout on TV. I was somewhat flabbergasted by that, as I believe his official position is that everything's fabulous, right? So it's a little unclear to me why he was talking about bailouts. Um, Bailouts of failing businesses in what my friend Martin Wolf calls democratic capitalism. We live in a democratic capitalist society. Bailouts of failing businesses in democratic capitalism is an extremely corrosive thing to do, particularly if it's done in a way that looks like you're rewarding the people who failed. And even worse, if there appears to be issues of corruption and illegality involved. Right? The 2008 financial crisis and the way it was handled under TARP, which I was involved in overseeing, did a lot of damage to the American people's trust in their government. And I got to tell you, I warned that at the time. I said, if you bail out the bankers and not the homeowners, if there's impunity for bank CEOs after the decisions they made and the lies they told, if we force the American people to recapitalize the banking system and bail out the stockholders and the bondholders who knew what the risks they were taking. If we do those things, we will deeply damage the American people's belief in democracy, and we will open the door for authoritarianism. So, what happened? Right?
That is
More
right.
or less, that's what happened. If there is a financial crisis, steps will have to be taken to avoid a runaway train. But those steps have to be done in a way that holds the people who caused the crisis accountable and does not make the American people the guarantor of their business risks. Right? Which means that if we have to do things to stabilize the financial system, we need the companies that have to be in some way propped up, and those will almost certainly be banks, not AI companies, or insurance companies. If there are companies that have to be propped up, they need to be put through a bankruptcy type process, which is what Dodd-Frank says. right? They need to have their stockholders wiped out. Their bondholders have to take haircuts. And to the extent the public puts money in, the public should get a return commensurate with the risk the public took when it put the money in. Those are the basic principles of financial crisis management in a democracy. But that's not what the companies are going to demand. They're going to do like Silicon Valley Bank did a couple of years ago and say, basically, bail us out and let us walk away with the money and don't hold us accountable and don't do anything and let the public just subsidize us. That we cannot do that as a country again. And right now, there need to be conversations had with both the regulators and the Fed and so forth that in a crisis, the law has to be obeyed. Dodd-Frank and its attendant laws that limit the ability of the federal government to rescue individual companies, those laws have to be followed. And B, to the extent that public resources are deployed to stop a runaway financial crisis, that they must be deployed for the public benefit and not for the benefit of either financial or tech CEOs or investors. Under capitalism, you invest and you take risk, and if it doesn't work, you pay the price, not the rest of us.
Right. Thanks. All right, we're getting a little close on time, so thank you so much, Damon. I want to make sure we bring in some of the questions we're getting from the audience now.
Of course.
And there seems to be, some themes, like the bailout is definitely a theme. So some of the questions we're
I'm
getting are,
shocked.
yeah, right, around what would be the most equitable way to resolve the crisis if it occurs, and how to avoid bailing out perpetrators of the AI bubble way, and the way banks were bailed out in 2008. Some of that has been, you just covered, but if you want to pick up on anything else, any other thoughts?
Well, basically, I have two rough thoughts, right? And they're very rough, right? To express an opinion about this, in abstraction is hard to do. Big businesses can fail and the economy can be okay. Right? Enron failed and it didn't destroy the economy. Bob Rubin begged the government to rescue his buddies at Enron. He claimed it was systemically significant. It wasn't. Well, the stockholders of Enron got badly hurt. Not every big company that fails needs a government bailout. Giant banks, giant banks with guaranteed deposits and a huge role in the credit system can't be allowed to just vaporize. That's what creates financial contagion. But that doesn't mean that the CEOs can't be held accountable. That doesn't mean the stockholders can't be wiped out. That doesn't mean the bondholders can't take haircuts. The issue with the big banks is to maintain the short-term assets and liabilities and allow them to function. And it's critical to restructure the capital structure of the big banks, because if you don't, you get sclerosis. If you do what Tim Geithner and Larry Summers did in 2008 and 2009, which is to try to freeze everything and then earn the capital back slowly over time by squeezing the public, you end up with a credit system that doesn't really function, and you get a prolonged recession. So what you need to do is you need to figure out what institutions really need to be stabilized. Most will not. You figure out what institutions really need to be stabilized to not have contagion, to not have a runaway train. And those institutions, you restructure their capital structure, you replace their executives, and you make sure that when the public money goes in, when it eventually comes out again, because these institutions will recover, when it comes out again, the public gets not a break-even return, but a return commensurate with the risk the public took in putting the money in. Those are your basic principles, right? I find it very unlikely that if any of the major AI companies failed, that there would be a good public policy reason to rescue any of them. What ought to be done if they fail is to put them through bankruptcy, restructure them, and put them back out on the street, like the railroads.
Okay. There is another question I wanted to maybe you could address, and it's about the exposure to state pension funds to all of these.
Well, look, we are. there's no good news here, really. We are all exposed to this, all of us. We're exposed to this in the risk of unemployment. We're exposed to this in our 401k plans. If we have them, we are exposed to this in through genuine defined benefit pension funds. Among the most secure things there are, by the way, in relation to a crisis like this, are well-managed defined benefit pension plans because of the way the relationship between the assets and the cash demands on the funds and so forth. State pension funds are mostly defined benefit funds. So let me just first say we are all exposed. Nobody is completely safe from a full-on financial crisis, which is why steps ought to be taken to ensure that we don't have a full-on financial crisis. But state pension funds should be looking at the same kinds of risks that I was describing that regulators should be looking at in the banks. And I think in particular, state pension funds should be looking very closely at any private credit portfolios they have, and looking to take steps to mitigate risks associated with those to the extent that they're involved in the AI business in any way.
Right. Yeah. If I may add, yeah, private state pension funds are hugely exposed through the private equity, private credit, and the insurance companies too, which private pension funds invest in a lot of insurance companies that have been
That's
doing
right.
some of the private credit lending.
But Oscar, can I just add this?
Yeah.
A state pension fund is among the most financially sophisticated entities out there. The people who run a state pension fund know more about the state of these markets and have access to better information than almost anybody. They have better information than I do, which is a good thing, right? It's a good thing that working people's retirement security be in the hands of professional, really capable organizations with real capacity to understand what's happening in the capital markets. But that capacity is only it's only as good as its use. They need to be asking these questions now. They need to put all that sophistication, all those advisors to work to make sure that they don't get clobbered the way some pension funds got clobbered in 2008, particularly those that were overexposed on private assets.
All right. We are almost at time, so I think we're gonna have to leave it here on the questions. Damon, I'll pass it back to you if you want to say any last words before we close
Well,
it.
let me just say this. A full-on financial crisis is a horrifying event. It destroys lives. It weakens economies for years. It destabilizes political systems. The 2008 crisis damaged the United States quite severely, more so even than it seemed at the time. The Great Depression is really one event with the Second World War. These are things it is worth not having. And so it is just incredibly important right now that the financial regulators in the United States, the center of the world's AI industry and the center of the world's financial markets, seriously turn over the rocks here and do everything they can to make sure that the kind of event that I'm talking about doesn't happen. It is not a foregone conclusion that it will happen. I think it's pretty likely that the stock prices of some of these Magnificent Seven companies are going to return to something more rational. But that does not mean we have to have a full-on financial crisis. I fear, though, that the mentality of like whatever the rich guys do is fine will once again produce disaster if there isn't a course change on the part of the Trump administration's regulators.
Damon, thank you so much for this conversation and for bringing both a lot of historical perspective and clear ideas about what regulators should be doing right now. I'll close by going back to why AFR is doing this series. We will continue these conversations and briefings on Trump deregulation and financial speculation and the risks of rolling back Dodd-Frank Act safeguards. And yeah, just please make sure to follow the work of FR and get on our listservs if you want to hear more about all of this. Thank you again, Damon, for being so
Thank
generous
you,
with your
Oscar.
time. And
Such a
thank you all in the audience for spending this time with us.
Take care.
All right.